Bank stocks have been outperforming, and I think the rise is going to continue. So let me tell you a little bit about the rationale of why I think they're moving now and what's in my core holdings. Now, as far as why they're starting to move, well, bank stocks have been undervalued for a long time. That's for a number of reasons. The primary reason over the years prior to COVID was that we were in a very low interest rate environment, and there was a concern that the banks just could not keep up with profitability. Now, you add into that what's happened with COVID. There's obviously the fear of default for commercial real estate, small business loans, especially businesses in the service sector. And then with oil prices dropping, there was further concern that all that oil debt was going to come due and wouldn't be able to be refinanced. Well, sentiment's changing on all that because number one, the economy is improving. COVID is going to burn itself out. Everybody's aware of that. So they're no longer worried about the long-term major defaults, especially in oil. You've seen oil prices come up significantly just since the election. I think oil's up some 30%. It's currently just under $50 or so a barrel. I think that's going to continue to rise. The other thing that's changing investor sentiment in the banking sector is that the Federal Reserve has been pumping in $120 billion a month for emergency COVID lending. There's no end in sight for that. The Federal Reserve has confirmed again this week that they're going to continue the low interest rate policy, and they're going to continue shoring up their balance sheet with $120 billion every month. So no end in sight for that. That means that the commercial real estate markets are going to be fine. They're going to be able to continue to refinance. All the business loan debts are not only benefiting from these lower interest rates and liquidity in the market, but then of course we have all the stimulus money and the additional emergency federal spending, as well as Fed loan issuances which are going out. We see now too that the Congress has just come upon agreement for the next stimulus package. So that's going to help all the banks, because now there's even less concern that these businesses are going to go further unprofitable or bankrupt. And then finally, and this is what I find most interesting, is that bank profits are up, and they're up significantly. And this is a reason why I've held on to my core positions, because I was not worried about the banks losing money. In fact, I think that this drawdown that we've seen, or stagnation that we've seen in the banking sector for a while now, is really beneficial because it's caused the banks to become more efficient. And so they're not only able to make money when times are bad, but as times are improving, they're going to make even additional profits. And then, of course, with all the trading that's going on, all the acquisitions, all the new home purchases, new mortgages, all the refinancing, that's all stimulating and very effective for bank profitability. There's a couple other underlying reasons. I won't delve into these hugely, but just this week, the Federal Reserve announced that they're going to allow banks to restart up their buyback programs. That's going to inject billions of dollars into the markets. So that's a good thing for bank prices. As far as my core holdings, I have been in banks for quite some time. I have known that despite the negativity, they were not going to go bankrupt, and they paid a nice dividend. So I thought it was worth holding on to them, collecting the dividend, and then eventually catching the profit as those prices rose, and they have risen. So my core holdings, KBE, that is a bank ETF. It focuses on the large money center banks. These would be the big names, the Chase, the Wells Fargos, Morgan Stanleys, the names that you would be aware of. Those make up the KBE Bank Index ETF. Another holding I had, or I currently have, it has been in my core holdings, is KRE. This is the regional bank index. This is the smaller community lenders. They were especially hard hit over the last couple years. That's been way outperforming. I expect that to continue. Another core holding I had several individual banks, but for example, one of those was JP Morgan Chase. Those are in my core holdings. They've been there for a long time. I don't have any plans to sell them in the near future. Now, in addition to that, I added with my COVID-19 portfolio, if you're following my blog posts, over at investablewealth.com. You know that just before the election, I jumped into 90 positions. I call them the COVID 90. These are recovery stocks. Included in that were 3 bank stocks. That was Citibank, Signature Bank, and then I also added to my JP Morgan holdings. And then, hey, one wild card, I'll probably do a separate episode on this because it's so interesting. I also bought Brinks. If you remember, Brinks is the security and armored car company. That's done really well. I expect it to do even better in the future. It's an ancillary to the banking industry, but it's worth note for another podcast, another episode if I get questions about it, because people think that money is dead. They think that cash or currency is in decline. Well, that is true, but at the same time, there are still a lot of opportunities like Brink Security and Brink Armored Car Company. There's a lot of opportunity for them to continue to make money even in a declining market. Well, hey, as always, thanks for joining me. If you want to learn more about what I'm doing, you can follow my blog posts over at investablewealth.com. That's where I tell you when I'm buying and selling things or when I think there's a change in the market. I post it there first. It's much easier for me to put out a blog post than it is for me to put out an audio or video podcast. As always, thanks for watching. Until the next episode, this is John Pugliano wishing you the very best returns.